there, everybody. Hey, this is Demel Gonzalez of Heartwood Financial Services. Hey, thanks for joining me for our latest market update and outlook video. This is for the month of December, which really closes out the year. Thank goodness, right? Well, we got a lot of great stuff about what's going on in inflation, the Fed, and how it relates to the markets. And I also talk about a unique event that happened this year in 2022. And of course, as always, my outlook. I hope you guys enjoy. Thanks. All right, let's jump right into the asset class returns for the month of December, which concludes 2022. Thank goodness, right? So what we're looking at here, a couple things to highlight. Large cap down 18%. This is the S&P 500 for the year. Real estate had the worst year, down 26%, and commodities had the best year. U.S. fixed income, which is the high quality fixed income, down almost 12%. So we're going to dig into that a little bit more of how unusual it is to have a negative year for fixed income and for the stock market. A couple other things that I would highlight for the month, though, you can see everything was down a little bit except for commodities. But you could see the relative performance of international was actually a little bit better than domestic. And that was a trend that continued from the last couple months as well. And so this is something that I've been keeping an eye on. I think it has mostly to do with the dollar. So we're going to dig into that a little bit more also in the outlook. But you can see it was flat to just barely down versus the S&P and small caps being down quite a bit. All right, inflation is slowing. Now, you've heard me talk about inflation a lot on these videos, and it's not that I like to pick topics and repeat them over and over again, believe me. It's that inflation is the main driver to what's going on with the Fed and all the central banks across the world, and what's driving the market. So we need to be focusing on inflation. So here, this blue line, this is the CPI, the Consumer Price Index. This is the big number that the federal government puts out, and they're looking at this very carefully. And it's obviously been high. It was 7.8% the previous month, and now it's down to 7.1. So it keeps kind of coming down a little bit, so that's very promising. And the other thing that I would point out is if you look at just the last 5 months and then you annualize the last 5 months, you're actually only up 2.4%. And so what I'm trying to say here is that we're on the right track, it seems like. The market is starting to anticipate a little bit of this, which is why it's been trying to make a little bit of a comeback here. Unfortunately, the Fed came back out and kind of put a squash to the party, which we'll talk about here next. All right, the Fed raises rates by 0.5, or what's called 50 basis points. Now, everything was going really good, especially after that last CPI report, and the market was starting to show a little sign of life. And then comes the Federal Reserve. They didn't raise rates by 0.75 like they had been the previous 4 times, but they still raised the rates, and they raised it by 0.50. So on the surface, you would think that that's actually really good. They're starting to slow down their rate hikes. But it was more about the language that they used after, they always have a little press conference afterwards. And especially Jay, we got him here with a frown. He was very hawkish, meaning that he was still talking really tough about the inflation worries and how they have to do a lot more, and then they're not going to stop anytime soon, and don't get too comfortable. It was very strong language. And you got to remember, the Fed, they have kind of two powers, right? They can control those rates and the balance sheet. but they also have the power of the bully pulpit, so to speak, and where they can go out and they can talk down the markets by their guidance. And this guidance was very, very negative because I think they're still a little concerned that inflation is high, and there's certain components of inflation that are still very high, especially the labor costs. And, employment is still very high, unemployment very low. So they're still trying to battle that, and they don't want to let the market get ahead of itself. And this is the same thing that happened in the 70s, where the Fed back then kind of let the foot off the brake a little bit, and things reheated and inflation got bad again. So they don't want that to happen, so they're still talking tough. And as soon as they did that, the market did basically a 180 and took a big hit for the rest of the month, which is why we saw the numbers in the asset class returns. All right, real quick, I also want to add that the international policymakers, the ECB and the Bank of Japan, they have also kind of been following the lead from the Fed, and they have been getting more aggressive. The ECB, which is the bank in Europe, they have been raising rates quite a bit and are talking about raising rates a lot more because they want to fight inflation. And even the Bank of Japan, which they rarely do anything hawkish, even they have started to allow their bond rates to go up a little bit. And so this is actually a pretty big deal because they've been keeping their rates low for decades. And so the fact that they're allowing it to go up a little bit is a big deal, showing that they are trying to fight a little bit of inflation that they have in their country. And that made the yen and the euro go up in value, which then makes the dollar go down. And I think this trend could continue at least for a little while. All right, the last slide for the update, and then I'll talk a little bit more about the outlook next, is what I call the black swan. And what we experienced in 2022 was, I think, a black swan event. Let me show you what I mean. So this is a chart that shows basically the S&P 500 and the 10-year Treasury, okay, split 50-50. And it shows the years when stocks and bonds were positive are in the blue, and when stocks and bonds were both negative in the red. And this is a chart that goes back almost 100 years. And you could see that this is a very rare event, especially if it goes down so much like it did here recently, where we had this type of mix down about 14-15%. So you can see the only time it was this bad was back in the Great Depression era, back in 1928, in that time frame, 1931, forgive me. So what I wanted to point out, first of all, how rare this is and to what degree we had this event, but then to flip it around and give you the positive news. When you look at the returns after these types of events, and mind you, these types of events also happen right in recessions or just before recessions, which we could be looking at here as well. The stock market averaged a very nice return over the next 1, 2, and 3 years. And so the average for a 3-year is anywhere between 28 and 53% over the next 3 years. And so this is basically a sign that things have gotten beat up pretty bad and things could really be turning around soon. Hard to say exactly when, but if you have at least a 1, 2, 3 year time frame here, it usually turns out in your favor to be investing during these black swan events. All right, I'll start the outlook with a slide here on the leading economic indicators. Again, these are the indicators that aren't just telling you what's happening. They're telling you about what the economy is going to look like in the future, which is why they're very helpful in doing forecasting for the market. And what you can see here is all these different indicators are plotted on this chart. And this quadrant here is what's called the declining, I could say that easily, right? Declining quadrant. And the red is the average of where they all are at. And so the closest it gets to this baseline, the closer it is to recession. And you can see that it's in the very close to the baseline, and it's in the declining quadrant, not quite in the contraction quadrant, which is a sign that we're already in a recession, but very, very close. Now, I would make the argument that that most people, I think, have a sense or have a feel that a recession or at least some sort of slowdown is coming. And I think that is essentially consensus. What nobody really knows is how bad is it really going to get. And we've talked about this before in these videos where I feel like we're probably going to be more in a mild recession, maybe even a soft recession. Not one of these really harsh type of recessions. But it definitely looks like it's coming. All right, I teased enough about this one on the asset class returns and during the update. So the dollar is definitely weakening. So I want to show you a chart where you can see this is for the last year of the dollar index. And remember, the dollar is measured relative to other currencies, and mostly it's the euro, the yen. Those are the two biggest components. And so what we've seen here recently is the dollar index has been going down. And that's actually a good thing for the stock market. So we'll see if this continues. But it's actually started to go down a significant amount. So that's what's starting to get me a little bit more interested in maybe looking at things like gold, looking at things like international stocks, which are denominated in those euros and yen and those other currencies. And so obviously this is something that I'm not 100% convinced of yet, because Europe especially is probably going into a much deeper recession than us. But because they are fighting inflation really hard, and because some of the recent events, like I pointed earlier in the update, I think this trend of weaker dollar could continue. Probably not going to go up to these higher levels anytime soon. All right, so here's the bottom line to everything, the Heartwood implications. And I actually have so much going on here, I gave it its own title, The Great Balancing Act. So overall, I'm not making any major changes to how much in stocks and bonds and others, but it's more what's happening under the surface of the water. And so I wanted to show you a few things that we're working on doing here. So we're going to be reducing large cap domestic stocks, adding a little bit more to the mid-cap names. They tend to start doing a little bit better when the markets starts turning things around. Also, like we talked about a moment ago, adding more in international, developed and emerging market. Especially emerging market, I feel even a little bit stronger about that one. China's starting to reopen. They're having some some issues reopening, and I think they're not going to go real smooth. But eventually, probably by mid-year, later in the year, they're going to probably be up and running pretty strong. So I definitely want to be exposed and have the proper exposure in those areas ahead of time. In the bonds, I am reducing cash and adding more to quality bonds. Basically adding what's called duration, which is interest rate sensitivity. I think interest rates have probably peaked in terms of what's happening to the bond market. Not what the Fed is doing, because they don't necessarily control the bond market. So what's happening there is with inflation peaking, the bond rates have probably also peaked too. So I want to be buying more of these bonds, especially now that they're at such attractive rates. And then on the last part, on the other, we're reducing all alternatives funds that were there to kind of act as a hedge, to not be in bonds and not to be overexposed to stocks. Reducing that exposure and adding now to gold, bumping that up a little bit since the dollar is starting to look like it peaked. We want to have the alternative to the dollar, right, which is the gold. And especially if there is a recession, and if it is a little bit worse than we anticipate, gold and the bonds will both be nice countermeasures there to work on our behalf. So hope you'll see there's a lot going on here. The asset allocation, big picture, not a lot of changes, but a lot of changes under the surface. Thanks, and if you got any questions, please feel free to reach out. God bless.